Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. We're going into the Federal Reserve raising interest rates by 75 points this evening. I expect that will be the case. I never thought there was any risk of 100 points or anything like that. The Fed wants to confirm to the market that it is serious about defeating inflation. It is prepared to be aggressive on interest rates in an ongoing fashion. For a long time, I've been forecasting there'd be 3, 5, 7 interest rate hikes in a row, and I think we're probably set still for another 2 to 3 75-point rate hikes from the Fed. So tonight's really a fait accompli. It's not the end of the process, and I think that's what markets will begin to process and price into equities and currencies even after this announcement. So unlike other Fed hikes where everyone was sort of hopeful there'll be a pivot or some nonsense like that, there was never going to be a pivot, and people are still talking about it. It's very odd. People previously thought, oh, this could be the last one or it'll be less next time. No, another 2 to 3 after this one. So market is likely, stocks are likely to be heavy, US dollar is likely to be strong, which brings me maybe to one of the opportunities I'm seeing in markets at the moment is shorting the Australian dollar. And of course, overseas for a long time, people have been critical about the Reserve Bank long before the Australian domestic economists and financial media picked up on it. It took them several years. Overseas, there's been talk for many years about the poor performance of the Reserve Bank of Australia. There's now an inquiry and a review of the Reserve Bank of Australia going on in Australia, of course, but that's an interesting story, and maybe we'll talk about that another time. All I'm saying, though, is that global investors do want to be invested in a currency that has an inept central bank, and probably not. Do you want to be invested in a currency that has been strong because of a resources boom in a fast-slowing global economic outlook? Probably not. Do you want to be long a currency where the interest rate deficit to the US dollar is constantly increasing meeting after meeting? And I said this before the last RBA rate hike of 50 points. I said that is bearish the Australian dollar. I'm going to say it again because it's a pretty good call. About a year ago, I was on a national TV program at 77.45, 0.7745 for the Aussie US, and I said the Australian dollar is going to 70 cents, and that was when a lot of people were forecasting 80, 85, 92. Went straight down, and we saw 70 cents, and then the end of last year in December, I forecast this year we'd be seeing 65 cents, and again, everyone thought that was a little bit of a big call. Well, yes, that's what I do. I don't get them all right, but I get some right. And I said there'd be a risk of 58 cents in 2023. I made those forecasts before the Ukraine war conflict even came onto the radar. So that continues to look good. We're not far from 65. What I'd like to point out to you today is if I'm right and the US dollar resumes its uptrend after this Federal Reserve meeting, the Australian dollar can very, very, very quickly be at my 65 cent target that I set for this year at the end of last year. The risk is that further 58 cent potential could actually be brought forward out of 2023, my original forecast, into the last quarter of this year, November, December perhaps. So keep an eye on that because the world has problems. The US dollar is going to increasingly be seen as a place for safe haven. Capital inflows to the US are streaking higher again, both for Treasury bonds and for US equities, but most investors around the world are bailing out of US equities. But still, there is a safe haven fear flow of buying into US equities, which people don't always appreciate that fear buying of US equities factor, which I identified many months ago was part of the reason we saw such a strong US stock market last year. Now, the Australian dollar, I think, is at risk right now, right this moment, of falling quickly towards 65 cents. If in somehow the volatility on a Fed rate hike night somehow triggers some people getting out of their short positions and a bit of a stop loss buying period for the Australian dollar, I would let that run its course, and then I would be a very, very aggressive seller indeed. So a lot of problems ahead for Australia, both on the external and internal fronts. It is not a good looking currency at all. So if you're thinking, oh, buy Aussie, it's a great currency, that's the past, okay? We've fallen from 10 cents and we're still falling. So it's not a strong currency at all. And we've been bearish and right the whole way down, and I'm still bearish, and I'm still trying to warn people. One of the reasons the Australian dollar can fall quickly is because most exporting companies have already hedged forward their export receipts. So even now, as they're generating revenue from their overseas sales, that's not necessarily seeing buying Australian dollar interest because it's been bought in advance and put out in the forward market. So the Aussie may not have as much support as some people think. Watch this space, but inept central bank, slowing global economy, deleveraging of commodities like other markets like stocks, and now increasingly property, a weakening property market, manufacturing getting very wound down as well in Australia, building permits collapsing in Australia, those sorts of things, not a pretty picture for a global investor. If Australians haven't figured it out, the rest of the world's figuring out really quickly to sell the Australian dollar. Thanks very much, Clifford Bennett.